Welcome back to the deep dive. So imagine you're looking at a company's audit report. Maybe you're thinking of investing or approving a loan.
Right, a big decision.
Exactly. And you're hoping for that clean bill of health, the standard unmodified opinion.
The thumbs up.
Yeah. But what if it's not that straightforward? What if the auditor says, it's a bit complicated?
Mm,
Or even worse, we actually can't give an opinion at all.
that definitely changes things.
It really does. So today, we're diving into those trickier situations, specifically qualified opinions and disclaimers of opinion. We want to figure out what these reports are really telling us.
What those signals mean, yeah.
Before we jump right in, though, just a quick reminder, this deep dive draws heavily on material from Farhat lectures.
Great resource.
Absolutely. All the content, the examples, the explanations, it's all derived from the accounting resources you can find at farhatlectures.com.
So if you're a student, CPA candidate, or even a practicing professional, definitely check it out.
For sure. They've got extra practice questions, video lectures, lots of support to really cement what we talk about today. Big thanks to Professor Farhat for providing this material.
Definitely.
Okay, so back to these audit opinions. If it's not that straightforward thumbs up, what does the auditor's opinion actually mean then?
Well, maybe it helps to quickly recap what makes an opinion clean or unmodified in the first place. That's our baseline.
Good idea. What's the checklist for clean?
Okay, so first, you need all the financial statements included, nothing missing.
Makes sense.
Second, and this is crucial, the auditor has to have collected sufficient appropriate evidence. They need enough good quality information.
Okay.
And third, based on that evidence, the financial statements have to present fairly according to the rules. Usually it's GAAP or maybe IFRS, depending on the situation.
Rigid fairly. Got it.
And generally, there shouldn't be any major issues requiring special paragraphs like an emphasis of matter, although sometimes even clean opinions have those, just to highlight something important.
Right, like a big lawsuit the company is facing or something.
Exactly. But the core opinion is still clean. So sufficient appropriate evidence and presenting fairly under GAAP, those are the big pillars.
Okay, pillars established. So when do those pillars start to look shaky? What causes an auditor to say, hold on, I can't give a clean opinion here?
Great question. Broadly speaking, there are two main kinds of roadblocks that stop a clean opinion.
Two main categories.
Yeah. The first one we often call a GAAP reason. This means there's something problematic within the financial statements themselves.
Like a mistake, or they didn't follow the rules.
Exactly. A material misstatement or a departure from generally accepted accounting principles. It's about the content of the financials.
Okay, so that's roadblock number one. The financials themselves have an issue. What's number two?
Roadblock number two is what we call a GA reason. GAA stands for Generally Accepted Auditing Standards. This is usually about a scope limitation.
Scope limited.
Yeah. It means the auditor had a problem getting that sufficient appropriate evidence we just talked about.
Ah, so it's not about what's in the statements, but about the auditor's ability to actually check them properly.
Precisely. Think of it like hiring someone to inspect a house, but maybe you tell them, sorry, you can't go in the attic.
Okay. Yeah.
They can look at the rest of the house, but their scope was limited. They couldn't gather all the information they needed for a full picture.
That's a really clear analogy. One's about the house itself having a problem, the other's about the inspector being blocked from seeing everything.
Exactly. GAAP issues are about the statements. GAAS issues are about the audit process.
Okay, this is where it gets really interesting, I think. Let's talk about the qualified opinion. Where does that fit in? It sounds less severe than some other options.
It generally is less severe, yes. A qualified opinion is interesting because it can actually result from either type of roadblock, a GAAP issue, or a GAAS scope limitation issue.
Oh, okay. So it could be either the numbers or the audit process.
Correct. But the key defining feature of a qualified opinion is that the issue, whatever it is considered material but not severe and pervasive.
Material, but not pervasive. What does that mean in practice?
Material means it's significant enough to matter to someone reading the financials. It's not trivial.
Right.
But not pervasive means the problem is confined. It affects a specific area or account, but it doesn't fundamentally taint the entire set of financial statements.
Okay, so like finding a crack in one specific wall of the house rather than finding the whole foundation is crumbling.
That's a good way to put it. The rest of the house might be fine, but that one area needs attention. A qualified opinion basically says, overall, these financials are presented fairly, except for this specific matter.
Which we're telling you about right here.
Exactly. It isolates the problem.
So could you give some examples? Let's focus on the GIS side of scope limitations.
Yeah.
What kind of limitation would be material, but not bad enough to sink the whole opinion, just qualify it?
Sure. Maybe the auditors were hired late in the year and couldn't observe the company counting its beginning inventory.
Ah, because they weren't there at the start of the year.
Right. Now, if inventory isn't a massive part of the business, or if they can perform other tests, alternative procedures to get comfortable, maybe that specific limitation leads to a qualified opinion, not something worse.
Okay, what else?
Well, perhaps there were some time constraints. Maybe the deadline was tight, limiting certain procedures. But again, the auditor felt they did enough overall work to have some basis, just not a perfectly clean one.
Makes sense.
Or maybe they couldn't get confirmations back for some accounts receivable. If those receivables aren't huge relative to everything else, or if they can verify them in other ways, it might just be a qualification.
So it's about the auditor judging the impact of not getting that specific piece of evidence.
Yes, and whether it affects the whole picture or just a corner of it. Another example could be difficulty getting a response from the company's lawyer about pending litigation, the attorney letter. If the auditor thinks the risk is low anyway, maybe it's just a qualified opinion. Or even inadequate accounting records, but only in one specific non-critical area.
It really sounds like auditor judgment is key here, assessing materiality and pervasiveness.
Absolutely critical.
Now, you mentioned limitations like time constraints or not being there for inventory count. Those sound like circumstantial issues. But what if the reason the auditor can't get evidence is, well, because management won't let them?
Ah, now that's a different ballgame.
Yeah.
There's a huge distinction between being restricted by circumstances, like a natural disaster flooded the warehouse where records were kept, versus management placing the restriction.
Because one just sort of happens, the other feels intentional.
Exactly. If management refuses to provide access to records or won't let the auditor talk to certain people or blocks necessary procedures, that is a major red flag.
What does the auditor do then? Just accept it?
Oh, definitely not.
What?
The first step is always to request that management remove the restriction. Explain why the information is needed.
And if they still say no?
Then the auditor must escalate the issue. They need to communicate with those charged with governance, usually the board of directors or the audit committee.
Put pressure on management from above.
Essentially, yes. And let the board know there's a significant scope limitation being imposed by management. This is serious stuff.
Okay, so management refusal is a big deal. But what if, even after escalating, the information just isn't available? Or what if the circumstantial limitation, like that flooded warehouse, was so huge it affected everything? Where do we go from a qualified opinion?
Right. If the scope limitation, whether it's imposed by management or caused by circumstances, is so significant that it's considered material A&D, severe and pervasive, then we move beyond a qualified opinion.
Severe and pervasive, meaning it does taint the whole picture.
Yes. It means the potential impact is so large or affects so many areas that the auditor simply cannot form an opinion on the financial statements as a whole. In this situation, related to a GAAS scope issue, the auditor issues a disclaimer of opinion.
A disclaimer, so they're not saying the financials are wrong.
No, that would be an adverse opinion, which comes from a severe and pervasive gap issue.
Right, okay.
With a disclaimer due to a scope limitation, the auditor is saying, we couldn't get enough evidence to tell you whether they are right or wrong. We simply don't know.
So the house inspector analogy again. I wasn't allowed in enough rooms, or the damage was so widespread I couldn't assess the overall structure. I can't give you an opinion on the house.
Exactly that. Because of the significance of the matters preventing us from gathering sufficient appropriate evidence, we do not express an opinion.
That sounds pretty damning for a company.
It is. It raises serious questions about transparency and the reliability of any information presented. But there's actually one other major reason for a disclaimer.
Oh, what's that?
Lack of independence.
Ah, independence, the cornerstone of auditing.
Absolutely. If the auditor determines they are not independent of the client, maybe due to financial ties, family relationships, providing prohibited non-audit services, they must disclaim an opinion, period.
So even if they did the whole audit, found no issues, collected all the evidence, if they weren't independent, they still have to disclaim.
Correct. Independence is paramount. And the report itself is very specific in this case.
How so?
If the disclaimer is because of lack of independence, the auditor's report is very brief. It basically just states that the auditor is not independent and therefore they cannot express an opinion.
That's it. They don't mention any audit work they did or any findings?
No, They must not. They don't describe any reasons for the disclaimer other than the lack of independence. They don't mention any procedures performed or refer to the scope of the audit at all.
Why is that? To avoid confusing people.
Exactly. Mentioning procedures might imply some level of assurance, which would be misleading given the lack of independence. The message needs to be absolutely clear. We are not independent. Full stop. No opinion possible from us.
Wow, that really underscores how fundamental independence is. It overrides everything else.
It really does. It's
Yeah.
the bedrock of the public's trust in the audit.
Okay, this is incredibly helpful in mapping out these different non-clean opinions. Let's try to quickly summarize the distinctions again. We have qualified, disclaimer, and we also briefly mentioned adverse.
Right. So let's tie it together.
Go for it.
A qualified opinion. This happens when there's a problem, either GAP or GS, that's material, but it's confined. It's not severe and pervasive. Think, except for this one thing.
Okay, material but contained.
Then, a disclaimer of opinion. This is issued for one of two main reasons. Either a GAS issue, a scope limitation, that is both material and severe and pervasive, meaning the auditor couldn't get enough evidence to form any opinion at all.
Right, that we couldn't check enough scenario.
Or it's issued simply because of a lack of auditor independence.
Got it. Scope limitations so bad they can't opine or not independent.
And finally, just to complete the picture, the adverse opinion. This is the worst one in terms of the financials themselves. It's for a GAP issue, a misstatement or departure from GAP that is both material and severe and pervasive.
So adverse means we checked and the whole thing is fundamentally wrong, misleading. Disclaimer means we couldn't check enough to say or we weren't independent. And qualified means we checked and it's mostly okay except for this specific bit.
That's a perfect summary. Captures the core distinctions really well.
So if a user actually gets a report that has a disclaimer, what does it physically look like? Any key phrases to watch for?
Yeah, the report title itself will usually say Independent Auditor's Report, Disclaimer of Opinion, or something very similar. Big clue right there.
Can't miss that.
Then, in the very first paragraph, instead of saying, we have audited, it might say something like, we were engaged to audit, reflecting that the process couldn't be fully completed.
Subtle but important difference.
Definitely. And the crucial part is the opinion paragraph. It will clearly state something like, because of the significance of the matter, described in the basis for disclaimer of opinion section of our report, we have not been able to obtain sufficient appropriate audit evidence to provide a basis for an audit opinion. Accordingly, we do not express an opinion on the accompanying financial statements.
Very direct, no mincing words.
No. And there will be that basis for disclaimer of opinion paragraph, which explained why they couldn't get the evidence describing the scope limitation.
Unless it's for independence, then it just says that.
Correct. If it's only for independence, that basis paragraph won't be there, just the statement about non-independence. The report will still typically mention management's responsibilities for the financials and the auditor's responsibilities under auditing standards, though noting they couldn't fulfill them, unless the disclaimer is solely due to independence.
Fascinating how structured and specific these reports have to be.
It's all about clear communication to the users, avoiding any ambiguity about the auditor's findings, or lack thereof.
Well, this has been a really insightful deep dive. It really highlights that an audit report isn't just pass-fail. There's so much nuance in these opinions.
Absolutely.
Yeah.
And understanding that nuance is critical for anyone relying on financial statements. A clean opinion tells one story, but a qualified or a disclaimer, they tell very different and very important stories.
It really makes you think differently about just glancing at the bottom line. You need to read the auditor's message, too.
Which actually brings up a good point for you, the listener. Thinking about these distinctions, qualified versus disclaimer, GAP versus GAAS issues, materiality versus pervasiveness.
Yeah.
How does knowing this now maybe change how you look at financial news or company reports? When you hear about an audit opinion, what questions might you ask now that you maybe wouldn't have before?
That's a great question to ponder. What's really behind that opinion?
Exactly.
All right, that wraps up our depth dive for today. We really hope this gave you some valuable insights into the world beyond the clean audit opinion.
Hope it was helpful.
And listen, to really make these concepts stick, the best thing you can do is practice. We strongly recommend heading over to farhatlectures.com.
Yeah, Professor Farhat has tons of multiple choice questions, true, false, exercises specifically on audit reporting and these types of opinions.
It's the perfect way to solidify your understanding. So invest that time in yourself, keep up the great work with your studies or professional development, good luck, and of course, stay safe.